All right, heroes, we're back. We're talking about earnings. So, what are earnings, right? What exactly are they? Earnings for all publicly traded company are a quarterly report of how the company did in the previous quarter, as well as the projections for that company for the next quarter, next 12 months, few years down the road, right? So earnings are a high level understanding or a high level snapshot of how a company did, broken down by their financials, their balance sheets, et cetera, et cetera. And then it's an expectation of what they're going to do in the future, right? So if you guys remember, stocks, quote unquote, are priced off of the risk-free rate of return, which we now know is zero, as well as forward earnings. Now, we are under the belief that you cannot predict forward earnings because so many things happen at any given time. A geopolitical event could happen that could completely change the forward earnings of a company. Thus, you shouldn't even work off it. But when a company projects how it might do over the next, say, 3 to 6 months or a year, those are the forward earnings. And then Wall Street analysts and banks, et cetera, they go ahead, they look at the balance sheet, they look at their own projections, and then come up with a new price or a price target based off the stock. Now, that's all fun and dandy, but how does that help us? Well, we have talked about for the majority of Market Hero so far about high excuse me, opportunities that are greater than average, right? They're greater than average. And earnings are a really awesome opportunity that happen overnight as opposed to, let's say, 50 days, like a lot of the strategies that we talk about in this course. So earnings are binary events, right? So a binary event is a one-time event, right? It doesn't really go on for a few days. Like, um, for example, a war that could increase volatility or decrease volatility will probably last, as just as an example, for more than a day. However, earnings, they come out, and once the news is out, that's it. Then everything is priced directly off of that news, right? And what's cool is just how we have an expectation for volatility over a year time or a 30-day time. We also have this expectation of this expected move overnight. So what's really, really cool, right? So we see that the expected move typically rises into these binary events um, as potentially large moves can occur. So with implied volatility or the expected move going up, that means that there's more uncertainty out there, right? And the reason that volatility or the expected move rises into earnings is because people have no idea what these companies are going to say. They might tell you they know, they might think they know, but they actually have no idea. If they knew and Wall Street knew exactly what these companies were going to do as far as their earnings, there would never be any volatility built in. But as you see here in a second on these next few slides, we'll show you exactly that happens, right? And the potential large move for us, right, is significantly reduced the next morning after earnings because, again, the news is already out, right? So we have the expected move rising into earnings because even though people say they know exactly what's going to happen, they don't know what's going to happen, right? So there's a lot of uncertainty, thus volatility, right? So what happens when the expected move is larger? Well, implied volatility is rising into these binary events and options prices are getting inflated. Now what happens is by the next morning, that risk premium is completely removed from those options. So all that premium of expectations in the expected move that was priced into the options the night before is completely removed, right? So this gives us a nice potential to sell high volatility and see that volatility be removed overnight. Now, it's not as simple as that. There are instances where the move in overnight for these stocks is larger than the expected move, right? So there are instances of that. However, in terms of just opportunity to sell something that's overstated rather than having it take 50 days to do that, in a lot of cases with earnings, it can happen overnight, which is really cool. So let's look at this for a second, right? So this perfect timing indicator that you guys see at the bottom of the screen, all it is a measure of implied volatility, right? And obviously, this is for you in one of the modules earlier on in this in Market Hero. This is available for you in all your platforms, right? But as you can see, this blue line, we have the expected move or implied volatility rising until earnings, and then as you can see in Netflix here specifically, almost overnight, that volatility is almost completely removed. And then over the next couple days after that, it's removed even more, as you can see. Now, again, the price of these options are going to be priced off the expected move, right? That expected move is going to get decreased over time, overnight in a significant way, as you can see here. Again, these arrows pointing to, you can see in October on the left side here, the expected moves greater and greater and greater. Options prices have more premium in them, and then boom, the prices, the premium in the options are going to get removed. Same thing going into, what is this, January, and then boom, premium expected move reduced overnight. Same thing going into May, boom, completely reduced overnight. Same thing going into July, boom, reduced overnight. Again, the price might fall outside of the expected move, in which case, or in some cases, we'll be a loser. It might fall within the expected move. In some cases, we're a winner. But the reality is, all we're looking to do is for these excellent high probability chances of us making money, where the expected move is overstated to the actual move, and this is an awesome way to do it overnight. And then Netflix is an example of that, right? Then we have Amazon here. Not as dramatic as Netflix. However, you still see a build-up and then a drop when the earnings come out. A build-up and then a drop. A build-up and then a drop, and then a build-up and then a drop. And again, these drops aren't as significant as, say, Netflix, but again, the expected move overnight is significantly reduced. So the premium that's built into the prices of those options will also be significantly reduced overnight. And that's all we're looking for. That's all we can hope for. Again, we sell options because the expected move is greater than the actual move. In positions, in times of earnings, the expected move is reduced overnight every single time. So that inflated price that's priced into those options is also reduced overnight. We look at Priceline, again, kind of similar to Amazon, not as extreme as Netflix, but again, the expected move is rising, thus options prices are rising. Boom, overnight, those options prices are reduced. Same thing going into earnings here, boom, reduced. Same thing going into earnings, boom, boom. So it's the same exact thing. So again, overnight, the expected move is significantly reduced, right? So earnings provide us ways to stay engaged in the market, right? So these, when the market is not really giving us the type of chances that we want to make money, right? It's not giving us a lot of excellent setups. They're a great way to stay in the game because we're always going to see volatility contraction and the reduction of expected move, right? So we might not see a high volatility setups in the overall market, let's say SPY or the NASDAQ or the Russell. However, in earnings, you will always see positions and setups and opportunities where the expected move is going to be reduced overnight. So again, that's a really, really nice setup for us. And again, the speed is key here. So rather than it taking 50 days like the normal days to expiration that we're used to with all these setups and all these strategies, it happens overnight, right? So when this is done right, and the next videos will show you how to do these right, when earnings are done right, they can add significant increase to your total P&L for the year. A large portion, like 25% of the money I make every single year, is devoted to these earnings. So stay tuned. I'll show you all about them here in a second.